that okay? Mr. Kent.
Thanks very much, Andrew. I'd like to thank the committee for the opportunity to contribute to the taxation review announced in last year's budget. ICSA believe that a progressive agricultural sector requires a tax regime which incentivises hard work and entrepreneurial spirit, assists those who have invested in developing and expanding their farms, supports efficient farm transfers between the generations without punitive capital taxes, features VAT and excise duty carbon tax that makes Irish agriculture more competitive, and encourages long-term land leasing, farm partnerships, land consolidation and installation of young farmers. We need long-term views, not on short-term gains, but when it comes to agricultural taxation. By that, we mean that the right tax incentives, which lead to better land mobility, encourages young farmers to take over and support better farming structures, will ultimately lead to greater tax take in the long run. However, even the best taxation policy cannot solve all the problems faced by the low-income dry stock sector. And I would be failing in my responsibilities to cattle and sheep farmers if I did not point out that we need to tackle the income crisis in these sectors as a priority. For some farmers, however, their choice will be to look at alternatives to continuing to lose money on current enterprises, and for them we must look at the tax implications of such decisions. Before I outline some of the key points made in our submission on the agri-taxation review, I want to clearly state that the ICSA is resolutely opposed to any talk of land taxes. Farmers, like everyone else in society, should be expected to pay tax in line with their earnings and their ability to pay. We know and understand that the overall taxation context is heavily influenced by external pressure to balance budgets and by the need to ensure that we can borrow from international markets. However, it is also important to appreciate that increased taxes are acting as a deterrent to hard work and investment. It is an article of faith that there can be no increase in the 12.5% corporation tax rate, because any increase would cost jobs and threaten foreign investment. Yet there seems to be no problem with taxing sole traders or self-employed people who are not incorporated at 52% on marginal incomes above $32,800. This is particularly severe in the context of enterprise trying to pay down principal on borrowings out of after-tax income. Accelerated capital allowances have been phased out. Example, 3 years for farm waste management scheme expenditure. And there are no allowances for land purchase, for example. Farm income volatility is also a huge issue that is impacted by tax levels. As volatility increases, farmers who have profit in a good year should ideally set aside some of this for the almost inevitable downturn in future years. However, saving up money to invest in the business should be regarded as prudent, but instead it is actively discouraged by dirt rates of 41% and more, importantly by high tax levels on profits. ICS submits that rainy day planning should be encouraged as an alternative to income averaging. This would be facilitated by allowing an unincorporated farmer to invest a proportion of profits in a good year tax-free into a special account, which could be accessed in future years for one of 3 options. For living expenses in a bad year, which would be subject to normal income taxation, or for investment in land purchase or farm development, and to cover exceptional costs such as extra feed in an extreme weather event. The key objective here should be that young farmers taking over the family farm should not be burdened with a potential crippling tax bill at a time when they need all the finance they can get to make a go of the business. From December 6, 2012, a Group A parent-child tax-free threshold was reduced to $225,000, progressively down from $434,000 in 2009, while the capital gains tax rate has been increased incrementally from 20 to 33%. Both of these measures increase the risk of significant tax liabilities for farmers who take over the family farm either by way of gift or inheritance. The above changes mean that a young farmer taking over the farming business where land and other assets exceed $2.5 million is at risk of a substantial tax liability on the excess at a rate of 33%. On the other side, on capital gains tax retirement relief, Budget 2012 provided for the introduction at the end of 2013 of a new upper limit of $3 million where a person transferred is aged over 66. While it is desirable to encourage early transfer of land, it is not always possible or desirable to do so. A potential capital gains tax hit for those farmers over 66 could have the perverse effect of encouraging holdings on to the land till death. In general, ICSA is concerned that the trend in recent budgets has been to expose more farms to greater risk of capital taxes on transfer, which we regard as very harmful to the overall objective of a young farming population. Stamp duty. ICSA has welcomed the general reduction in stamp duty to 2%. There is a special rate of 1% for transfers between blood relatives and 0% for young trained farmers. However, these rates are temporary and we would like to see them established on a more permanent basis. Stock relief is vital for farms which are expanding. Again, we would like to see stock relief rules in place on a more permanent basis. Farmer structuring relief. We welcome the introduction of the relief. However, there are two problems here. First, the relief is only available until the 31st of December 2015. This needs to be extended indefinitely. There is no reason for a short-term incentive. Farms can only be restructured when the opportunity arises and when it coincides with the financial wherewithal. Second, the relief does not provide for sale and purchase of entire farms. However, it is clear that in many cases this will be the most efficient route to consolidating a farm holding. ICSA therefore submits that such transactions should also be facilitated. Long-term leasing tax exemptions. The exemption of certain income from long-term leasing of agricultural land applies a number of restrictions on qualifying lessees. ICSA submits that this is unduly restrictive and is hindering stated government policy on land mobility and fractionalisation of partnerships and collaborative arrangements. Specifically, it is not possible to avail of the relief on incomes up to 12,000 in the case of 5 to 7 year leases, 15,000 on leases of 7 to 10 years, and 20,000 on leases greater than 10 years, where the lessee is a company or where the lessee is a person with whom the lessor is in partnership. The uptake of tax relief has been low, suggesting that it is not achieving its key purpose. The key reason is that many farmers are extremely reluctant to commit to the total loss of control over their land for an extended period. ICSA submits that it is highly desirable to encourage older farmers to consider entering into partnerships with young qualified farmers. This is a more desirable option for some farmers who do not wish to retire totally, and where a partnership could potentially bring much greater benefits in terms of developing a farm, facilitating the involvement of young farmers on a collaborative or partnership arrangement. In cases of genuine registered partnerships, there is a need to ensure both partners can achieve a reasonable economic outcome. It is also necessary to ensure that the relief for long-term leasing does not conspire to undermine the option of partnership. However, at present, the rules means that land cannot be leased to a partner, and therefore the older farmer is facing with rejecting the partnership option in favour of long-term leasing to a third party with whom there is no collaboration. In turn, the older farmer may see that as undesirable as there is no involvement in sharing experience. Keeping some control over the management of the farm or participating in the development of a business will be much more efficient under a partnership model and potentially more likely to facilitate new trained entrants compared with simply leasing out to the highest bidder. ICSA submits that there is an urgent need to support more land mobility and that the preferred route should be through partnership. Accordingly, the long-term leasing tax incentive should also allow the qualifying lessees would no longer exclude a person who is a registered farm partnership with the lessor, a company which has been set up for the purpose of a farming partnership arrangement, and where there is a registered farm partnership in place involving a second partner who is not a family relation of the lessor. ICSA also submits that the long-term leasing incentives need to be pushed more. We suggest that the highest level of leasing income exemption of €20,000, which currently applies to leases in excess of 10 years, would be allowed for leases of 5 to 7 years for a once-off period of 3 years with a view to encouraging older farmers to move away from Conacher. We believe that the current 10-year requirement for this is too daunting. Carbon and excise duties. The increase in carbon tax in recent budgets has not helped the viability of farms and agricultural contractors. Excise duties are also damaging. The double tax refund available against the carbon tax is extremely cumbersome. and not well understood, it is manifestly preferable to simply reduce carbon tax and excise duty on agricultural fuel. Employee tax credit. ICSA believe that the employee tax credit discriminates against the self-employed, including full-time farmers. There is no longer any justification for this discrimination, which potentially costs an individual full-time farmer €1,650 in extra tax, assuming a tax liability. ICSA believes that the employee tax credit should be replaced with an earned tax credit in line with Commission on taxation, although it should be phased in quickly rather than over time. Thank you very much.
Thank you, Mr. Kent. Mr. Punch.
Yeah, just first of all, income averaging, that's why we've made a proposal for rainy day funding, which is, I suppose, similar to the bond idea that Macro said there, because income averaging is a little bit crude and inflexible in various cases. It's not available to all farmers. It can be limited if there's off-farm income or if they're involved in other businesses as well. So that's one point. And the second point is that once you get into it, you're stuck in it for 3 years, and that becomes a problem. And the third one is that you only ever really go for income averaging when the problem arises, and that's not really what we'd like to achieve here. So what we're saying is that people should be encouraged, when years are good, to have the possibility of putting some of their profits aside into a fund, call it a bond if you like, or whatever, and that can be sheltered from taxation until the time they draw it down in the future. And they draw it down in the future because at that point either they have an income crisis, in which case they'll be paying a lower rate of tax when they draw it down anyway, or alternatively they have an investment project that they want to put it in, or alternatively there's, let's say, a fodder crisis. But by facilitating people putting this money away each year where they have, let's say, surplus profits over and above what they might need, you're encouraging planning, and it's not done on the basis that, you know, with income averaging, you suddenly have 1 year and you're locking yourself into this 3-year thing. Just, if I may as well, on the issue of Conacre, long-term leasing and collaborative arrangements. We've made a proposal there, and I think it's important to understand what we're saying here. Of course, we all agree that short-term Conacre is not the best deal. Okay? Long-term leasing is preferable to that. But collaborative farming, in turn, is preferable to long-term leasing. And long-term leasing is fine where a farmer has made a decision that he's finished with farming, that he's retiring, that he's happy. But that's simply not the case for a lot of farmers. And I think we're going about it all the wrong way if we think we can encourage guys to lease out the farm for 10 years and say day to farming. That lesson has been reinforced now by the recent cap reform, where people who have got out of farming and leased out their farm for a long time are high and dry now on cap reform. So obviously there's a lesson there to people, which is don't lease out all your farm or go for short-term arrangements. And for all of those reasons we've said, plus the fact that we have people coming to us now who are sick of being involved in businesses that are not profitable, cattle and sheep businesses, year in, year out, they're making no money, and they're saying, I've got to do something different. But retirement is not on the agenda here for these people. So collaborative farming might be a possibility. I'm not saying this is a flood, this is a trickle, but the trickle has to be encouraged. And in that case, you have this strange dilemma that under the long-term leasing tax relief arrangements, you can't lease into a company and you can't lease into someone with whom you're in a partnership with. And this is where the problem arises. So someone looking at a collaborative arrangement needs to be able to understand, how am I going to get income out of this arrangement, and how is my new farming partner going to get income out of it as well, and sufficient income for 2 families. And one of the issues here is that if you can manage to make profit, then you've got taxation issues. On the other hand, if you go in for a long-term lease, you can get up to 20,000 tax-free. So it doesn't, that particular rule there on long-term leasing is an active disincentive to going into a collaborative tax or a collaborative share farming partnership type arrangement, because it is almost certain that the smart thing to do from an income point of view is simply lease out and take the 20 grand tax free. But on the other hand then, that's not attractive unless you're absolutely convinced you want to finish farming and you're happy to go retiring. So we've got this logjam where the 10-year 20,000 tax relief is not attractive, and that's an obvious fact because it's not been taken up. The short-term Conacre is the worst possible arrangement for all. There's a kind of a general agreement that collaborative arrangements are what we need to be looking at. But here we've got to make sure that the taxation system is working favourably for collaborative arrangements and that it is matching at least the taxation, I suppose, treatment compared with long-term leasing.
Okay.